Probably in the last few years, groceries have doubled. Easy. They're crazy.
It's definitely been a very muted trading period.
Cost is always increasing.
Despite the fastest rate hiking cycle in history, squarely aimed at slowing spending, prices keep marching higher. But so do costs, especially for small business operators.
Worldwide, things like freight costs, manufacturing costs, it's definitely squeezing margins. But then on top of that, people are obviously having to be really mindful of where they're spending their money at the moment.
And that challenge isn't easing. Inflation accelerated more than expected in the March quarter to 1%. That took the annual figure to 3.6%. It was driven by fee hikes to healthcare and education, as well as rents, which grew at their fastest annual pace in 15 years, but would have been higher if rent assistance hadn't been increased. Insurance premiums also jumped by their most in 23 years.
This inflation data will renew some of that debate around whether we actually need to see higher interest rates. We don't think that we will see a further rate hike from here. I just don't think it's necessary. But the quarterly inflation data definitely means that that risk of a near-term rate cut has absolutely disappeared.
That's not good news for businesses like this women's boutique.
If you know you've got a mortgage of $1,500 a month and suddenly it goes up to $1,621 or something, it does make a difference.
Liz's customers are having to make their dollars go further.
It's not like 10 years ago where you bought a piece because you were going to a wedding. Now you buy a piece that goes to the wedding, that goes to dinner, that you can dress down for work.
Australians feeling the pinch are frustrated with repeated price hikes.
I think they're still going to keep creeping up, because I think they're getting away with it.
I'm working 2 jobs that pay 30 plus an hour, so that, you'd think you'd be able to make enough off of that.
The Treasurer hopes to ease some of that burden next month.
As we finalise the budget, our primary focus on inflation and the cost of living, but not a sole focus on inflation.
The inflation numbers are a sobering reminder. The battle is far from won, and forecasters are now pushing out their predictions of a rate cut to November or December. While that's unwelcome news for many, relief is in sight. Some economists say that $20 billion worth of tax cuts taking effect from mid-year are as good as 1 or 2 interest rate cuts.
I don't know whether that's enough of a difference to make a significant change to spending patterns. I think it's more the psychological impact of we're getting a tax cut from the 1st of July. I'm feeling better about that.
For now, small businesses like this restaurant are thinking outside the box to entice cash-strapped customers in the door.
I only just recently bought the hairdressers next door and we expanded.
Joivens also increased his operating hours as he tries to improve his margins.
Sitting here and praying that things will somehow revert to some better time is not going to happen. We just have to adapt and see where we can go from here.
As Charles Darwin said, it's not survival of the fittest, but of the most adaptable to change.
Headline inflation came in at 3.6%, but the Reserve Bank's preferred measure of core inflation was 4%, well outside the RBA's target band. The upside surprise prompted a flurry of revisions to rate cut forecasts. Australia's largest bank, the Commonwealth, was among them. It had been predicting a 0.7% rise. Chief Economist Stephen Halmerick joined me. Welcome to The Business. When is the RBA going to cut interest rates?
Well, before this inflation number today, we had thought that the base case would be for a September rate cut, and we thought the risks around that were evenly balanced. But after this inflation number today, we think the risks now are a bit later, so the November board meeting.
What specifically has prompted you to change your call?
Well, the inflation number today was higher than expected. There's no two ways around that. So the quarterly increase of 1% against our forecast of 0.7%. The annual rate still declined. It's down to 3.6% from 4.1 last quarter. But that's a little bit above the Reserve Bank's forecast profile, which was 3.5%, so just a touch above. So a higher than expected number today, inflation not coming down as rapidly as the Reserve Bank would have liked to have seen. that's what's caused us to reassess the timing of that first rate cut.
The Aussie dollar jumped when the CPI came out. Markets are factoring in that interest rates will be higher for longer. Can a rate hike be ruled out?
Well, it's interesting that the Reserve Bank's changed their rhetoric. Earlier this year they were saying that the risk was still for another rate hike, and then they've changed that to, well, the risks are now evenly balanced. So we still think that the next move in interest rates is down. As I mentioned, although inflation today was a little bit higher than expected, it's still lower than it was in the previous quarter. So inflation rate is still decelerating, just not quite as quickly as the RBA would have liked.
Do you think the RBA is going to have to revise its inflation forecast when it next meets in 2 weeks' time?
Yeah, so in early May we'll get a full set of the revisions again. So as I mentioned, they were forecasting inflation at 3.5% in the March quarter. It was 3.6%, so only very marginally above their forecast. So it's unlikely they'll have to change their forecast dramatically from where they are now.
The cost of housing has been an issue in the US economy. Is there a risk that the rise in rents and the high levels of migration here will also prompt a rebound in some economic indicators that the RBA really doesn't want to see right now?
Well, certainly the housing and rents, housing costs, construction costs were one of the main reasons why the inflation number was higher than expected today. We can see, in nearly all the data on the housing market, that the big issue is there's more demand and not enough supply. We're not building enough new homes and getting those into the system, certainly not fast enough. And that big gap between demand and supply of housing is likely to remain in place for quite a number of years, and that's putting upward pressure on both prices and rents. Now, whether that then feeds through to other inflation through the economy, I think the Reserve Bank will be watching that closely. But we can also see through our own internally generated data that consumer spending is quite weak, and so if the consumer's soft, it's unlikely we'll get a big rebound in economic activity and therefore inflation over the next 6 months or so.
Are there other similarities or even key differences that you are noticing when you look at Australia's economy compared to the US one right now?
Well, the biggest difference is actually income growth. So in the US, they've had an increase in real income, real household disposable income. Here we've had a decline. So that's the combination of the effect of the higher interest rates, higher taxes being paid, and higher inflation has meant that income growth in Australia is a lot weaker than the US. And our economy is actually a bit softer than the US as well. The annual growth rate here, 1.5%. The US is certainly a lot higher than that.
What does CBA's own data reveal about who in Australia is really feeling the pinch right now from the tight monetary policy?
Well, if we look at age demographics and things like savings, we can see that the age groups all the way up to 55 are now eating into their savings. So they're having to use that accumulated savings to keep spending up, including rents and mortgages, whereas those aged 55 and above are still accumulating savings. And I think that's a good proxy for home ownership status as well. So generally people 20 to 34 probably renting, you can see their savings going backwards. The 34 to 55-year-old age group probably have a mortgage, generalising here. And of course mortgage costs have increased a lot as well. So certainly the younger demographics and middle are really bearing the brunt of this adjustment due to higher interest rates and higher rental costs.
Overnight, the Bank of England's chief economist cautioned against cutting interest rates too soon. The UK is much closer to its target than Australia. Is it better to cut late than too early?
Well, I think that's where the central bank messaging has moved to. Earlier this year they were talking about rate cuts relatively quickly. The US Federal Reserve's changed their rhetoric as well. So I think in this environment where inflation was very, very high, post-COVID, if we can call it that, it's decelerated quite quickly, but that deceleration now looks like it's stalling. So central banks are likely to keep rates on hold for longer. But having said that, we do expect both the ECB and the Bank of England to be cutting rates around about the middle of the year, and then for the US Federal Reserve to be cutting around about September. So we do expect rate cuts in the second half of this year across most of the major central banks, but a little bit later than previously expected.
How judicious does the federal government need to be when it comes to spending in next month's federal budget, balancing its priorities of fighting inflation and gearing the economy for future growth?
Yeah, so for the budget, I think it's going to be important that they maintain a small surplus. We had a small surplus in financial year 23. For this year, financial year 24, it looks like will be small surplus again. And I think for financial year 25, it will be important to try and aim for another small surplus. So that's keeping fiscal policy relatively neutral, so not adding too much more into the economy. Clearly, we've got the income tax cuts coming on the 1st of July. And I think in terms of stimulus or extra spending for the economy, that would be the main measure, and keeping a small surplus, I think, would be the target.
Stephen Halmerich, thank you.
My pleasure, thank you.